Welcome to the Deep Dive, the show where we cut through the noise and really get you straight to the insights. Today we're plunging into a topic that I think perfectly encapsulates the thrilling, sometimes kind of wild evolution of modern finance. Just cast your mind back to, 2013? A little company called Robinhood stormed onto the scene, and they completely upended the financial landscape. I mean, they didn't just make investing accessible. They made zero commission the norm. They rocketed to a peak of 25.8 million funded accounts and a staggering $221 billion in customer assets by Q1 2025. It's just a story of meteoric growth and, undeniable disruption.
It really is remarkable how swiftly they redefined what was possible for, the everyday investor. They essentially forced even the biggest legacy players, the Schwabs and Fidelities, to adapt or get left behind. That kind of market shakeup is pretty rare.
Absolutely. And now, well, they're at it again with what might just be their boldest move yet, and maybe their most controversial too, blockchain-based stock tokenization. So this deep dive will unpack all of it. We're drawing heavily from the Wall Street Millennial YouTube channel's piece, Robinhood's Wildest Innovation Yet. Our mission today is simple. Cut through the hype, explore what this innovation truly means for finance, for crypto, and most importantly for you, the retail investor. You're going to leave here well-informed, ready to understand the nuances of this token gamble. But to really get Robinhood's latest move, I think we need to first journey back a bit to where it all began. Okay, let's set the scene. Robinhood, founded in 2013. Truly revolutionized trading. They pioneered zero commission stock trades. I mean, that concept was almost unheard of back then. And this innovation, it forced every major brokerage to follow suit by 2019. Zero commission became the standard in the US. After their 2021 IPO, wow, they saw meteoric growth, over $80 billion in market cap at one point. Customer assets just soared right
From $62 billion in 2022 to $221 billion by Q1 2025. But the real question, the one you might be asking yourself, is how does a company giving away trades for free actually make money? What's the secret sauce?
Yeah, that's the million-dollar question, isn't it? And it's absolutely crucial for understanding their business model. Robinhood sustains this zero commission thing primarily through something called payment for order flow, PFOF. So instead of executing your trades directly on, say, the New York Stock Exchange, Robinhood rates them. They send them to large market-making firms, like Citadel Securities is a big one. Now, these firms profit from tiny differences in the bid-ask spread, that little gap between the highest buy price and the lowest sell price. And while these spreads are minuscule, fractions of a cent for really liquid stocks like Apple, they become significantly larger for things like options trades. And that translates to higher potential profits for these market makers, who then pay Robinhood for sending the orders their way, for the order flow.
Right. So it's a bit like they're getting paid for directing traffic, essentially. And it gets even more interesting when you look at their other revenue streams. Crypto trading, right? Believe it or not, only makes up about 11% of Robinhood's total trading volume. But get this, it generates 4 times more revenue than stock trading. How does that work?
Well, that's largely because there's no equivalent of the regulatory order protection rule in the crypto space. Not yet, anyway.
Oh.
And that's a really important distinction. You see, the order protection rule in traditional finance, it's designed to ensure investors get the best available price for their stock trades. Its absence in crypto means market makers have more flexibility in pricing, which can lead to wider spreads, greater profits for them, and that then filters back to Robinhood as higher PFOF or similar revenue. Beyond that, options trading, as we mentioned, remains a significant earner. It brought in, a cool $240 million in revenue for Robinhood.
Fascinating. And they're not just making money on the trades themselves, right? I know they also generate quite a bit from, just cash sitting there.
Exactly. Robinhood also earns substantial interest revenue from idle cash balances. They have this cash sweep program. If you're a gold member, you pay for that. You earn 4% interest on your cash, typically swept into money market funds. But if you're not a gold member, that cash often gets invested in T-bills for Robinhood's own benefit. So they earn the interest, while you, the non-gold user, earn nothing on that idle cash. The gold membership itself costs $5 a month, does offer other perks, like instant deposits, the Robinhood Gold credit card with 3% cash back. Though that credit card, it seems to have seen pretty limited adoption so far, only about $429 million in loans outstanding. But ultimately, all these different streams, PFOF, crypto, options, interest on cash, they've made Robinhood quite profitable. They reported a $370 million operating profit in Q1 2025. That's a healthy 40% margin. Sounds like they've definitely figured out how to make money, even when the market's, taking a breather.
Wow, a 40% margin, that's quite something. And it's this
highly refined and diverse revenue engine that really sets the stage for Robinhood's next big move. It's crucial for you, listening, to grasp how this underpins everything they do, because it helps explain why they might be pushing boundaries again. So, given that robust financial engine, maybe it's less surprising that Robinhood is now making an even bolder play. June 30th, 2025. They make this big announcement. European Union users, right, can now buy stock tokens on a blockchain. Now, these tokens are designed to track the performance of stocks like Apple and even, interestingly, private companies like OpenAI and SpaceX. But here's the kicker, the crucial part. They do not represent legal equity. So what exactly are these things then?
Okay, let's break down the mechanics, because the details here really, really matter. You, the EU user, pay 1. Robinhood then takes that euro, converts it, and buys a real share of a stock, let's say Apple, on the US market. However, you don't actually receive that Apple share in your account, not directly. Instead, you get a token. Think of it as a digital placeholder, or IOU. And this token lives on the Arbitrum blockchain. Arbitrum is a popular Layer 2 scaling solution for Ethereum designed to make transactions faster and cheaper. Then, when you decide you want to sell your token, you signal that to Robinhood. Robinhood liquidates the underlying stock they hold and sends you the cash proceeds. So you're never holding the stock directly. Robinhood holds it.
Okay, and Robinhood themselves, they listed some pretty compelling benefits or claimed benefits for this new system. They said it offered fractional shares for 1, okay, 0 commissions, and even 247 trading, even when markets are closed. I mean, that sounds like a pretty significant leap forward, doesn't it?
It certainly sounds innovative on the surface, but this really raises an important quote about genuine utility versus, just a new wrapper. Fractional shares and commission-free trading, they already exist widely. In the traditional financial world, you can get those from many brokers without any blockchain involvement. So those aren't exactly breakthroughs in themselves. Now, 24/7 trading is indeed new for these kinds of assets, that's true. But it's critical to understand that Robinhood's own pricing model, not actual live market prices, governs those trades during off-market hours. Essentially, Robinhood is acting as the market maker during those closed periods. They set the price, and despite all the talk about blockchain, the process is still highly centralized. Robinhood owns the underlying stocks, not you. You own a token issued by Robinhood. It's basically a digitized claim on an asset that Robinhood controls.
So if it's not really that innovative for the retail investor, in terms of access or cost savings, what's Robinhood's strategic play here? Is it like regulatory arbitrage? Is it just a branding exercise to look cutting edge? Or maybe a play for a new demographic like crypto native users in Europe? You really have to wonder if it's truly a leap forward or, as you said, just old wine in new bottles, maybe with a crypto label slapped on. And it's precisely this question of genuine innovation versus maybe just hype that leads us right into the most controversial bit of their new offering. Because Robinhood took this a step further. They gave EU users free euro tokens representing fractional shares in private companies, specifically OpenAI and SpaceX, as a promotional airdrop.
Yeah, and the reaction to that was swift and pretty strong, almost immediate. OpenAI, for instance, they put out a statement right away disavowing the tokens. They explicitly said, these are not real equity. We did not authorize this. And this highlights a fundamental issue. These tokens are merely synthetic representations, meaning they just mimic the value or performance of an asset, maybe based on secondary market data or Robinhood's own assessment, but without any actual ownership link. And critically, investors who got these free tokens, they can't even trade them yet. Only Robinhood gets to decide if and when they'll allow sales or if they'll redeem them for some value. The control remains entirely 100% with Robinhood.
Right. And if you're a retail investor thinking about this, the bigger concern here has to be that these tokens are basically futures-like instruments, but with absolutely no real shareholder rights attached. It just begs the question, what exactly are you buying or holding?
This is a major point about investor protection, or maybe the lack thereof in this case. Retail investors, you typically lack access to crucial due diligence tools for private companies. You can't just pull up their financial statements easily. There are no standard company disclosures like you get with public stocks. So it's fundamentally impossible, really, to evaluate whether a tokenized private share is worth the price Robinhood might assign it. There's just no visibility into the company's health, no governance rights, and crucially, no legal ownership of the underlying company. You're effectively investing in a black box, entirely dependent on Robinhood's good faith and their internal valuation methods for any potential value or liquidity down the road.
Yeah, it certainly makes you think hard about the transparency aspect and the inherent risk implications of putting your money to something so opaque. A sobering thought, for sure, for anyone maybe tempted by the idea of getting in early on big private names like OpenAI or SpaceX this way. But despite all these pretty significant concerns we've just talked about, Robinhood launched this with a lot of public hype. They even put on this cinematic event in France called To Catch a Token, very James Bond-esque.
Yes.
And to lend even more credibility to the whole blockchain effort, Ethereum co-founder Vitalik Buterin himself actually made an appearance. The spectacle was certainly impressive.
It was. And what's truly illuminating here, I think, is how much fanfare surrounded what is, when you strip it back, a pretty superficial innovation. The Wall Street Millennial article puts it very bluntly, and I think it's a perfect summary quote. Everything offered already existed, only wrapped in crypto language. It really highlights a common trend we sometimes see in the blockchain space, wrapping existing concepts in new tech jargon.
Right. So, okay, let's boil this down. What does this all mean for you, the informed learner, trying to navigate this rapidly evolving financial landscape? After this deep dive, what are the key insights, the takeaways to really hold on to?
Okay, I think there are a few crucial ones. First, remember that tokenization in finance, despite its futuristic appeal, can often just replicate existing products, sometimes with added complexity and potentially less transparency. It's not inherently better just because it uses a blockchain. You have to look deeper. Second, real decentralization means genuine user control over their assets, not just putting some data on a blockchain while a single corporation retains full control over the actual underlying shares or value. If Robinhood still owns the stocks, you're relying on them, their solvency, their decisions, not just the blockchain, for your ultimate claim. Third, and this is maybe the most important for the private tokens, retail investor protections, things painstakingly built into traditional markets over decades, can effectively vanish. They disappear when you tokenize private equity without any accompanying transparency, disclosure requirements, or regulatory oversight. You really need to ask yourself, what rights do I actually have here? What do I truly own? And ultimately, I think it shows that crypto is still very much searching for those killer real-world use cases beyond speculation or existing financial product replication. And while this attempt by Robinhood is certainly novel, maybe attention-grabbing, it's probably not quite that breakable application we're all still waiting for in finance.
And there you have it, our deep dive into Robinhood's journey. From disrupting traditional brokerage, forcing that zero commission change, all the way to its ambitious, yet, as we've seen, highly controversial venture into tokenized assets. We've tried to peel back the layers today to see that crucial difference between claimed innovation and actual tangible utility for the user, especially when it comes to those private company tokens.
Yeah, and maybe a final thought to leave you with. As technology continues to push the boundaries of finance, constantly blurring lines, how can you, the informed learner, really distinguish genuine innovation that actually empowers investors from what might just be marketing spectacle that merely adds complexity or maybe even diminishes your protections? And fundamentally, what does ownership truly mean in this coming tokenized world? Especially when you don't actually hold the underlying asset, but rather a digital representation controlled by an intermediary. It's certainly something worth pondering as you navigate tomorrow's financial landscape.